All right, let's jump right into this explainer. Have you ever looked at a bank's earnings report and just gotten swept away by those big, bold, PR-approved numbers flashed right on page one? It's super easy to do. But as we're about to see, taking those headlines at face value, that can be incredibly dangerous for your portfolio. So today, we're zeroing in completely on step 4 of our professional banking analysis checklist. This step is all about checking the trajectory of a bank's asset quality. We're going to play financial detective today and dig beneath the surface to uncover hidden stress long before it ever hits the front page. Think about it this way. When you drive your car, do you spend the entire trip just staring into the rearview mirror? Obviously not, right? You'd crash. But here's the crazy part. In banking analysis, that is exactly what most amateur analysts are doing every single day. They're judging a bank's future by obsessing over its past. See, when you look at the most commonly reported metric for bad loans, you're only seeing what's already happened. You're looking at loans that have already failed, assets that are effectively already dead. Those headline metrics don't tell you where the bank is headed. They literally only tell you where it's been. So to really figure out what's going on, we need to contrast those traditional headline metrics with a couple of new investigative tools. Take gross NPA, or gross non-performing assets. That tells you about the past. Those are the loans that are already bad. But if we want to see the future, we need to look at slippage and the special mention account book, or SMA. This is where fresh stress is quietly building up. Step 4 of our checklist is entirely focused on this specific transition. It's all about checking the trajectory to see the future of the bank's health rather than just, tallying up the casualties of the past. To pull this off, you've got to understand the actual life cycle of a failing loan, because it doesn't just happen overnight. First, you've got a good loan. The borrower is paying on time, everything's great. But then, trouble starts brewing, and the borrower falls just a little bit behind. That's when the loan moves to step 2, the special mention account. Now, it's not officially dead yet, it's just struggling, but if things don't improve, we hit step 3, slippage. This is the actual moment the loan officially turns bad. And finally, step 4, it becomes an official NPA. By the time it hits step 4, honestly, the damage is already done. We want to catch the trouble at steps 2 and 3. Let's zoom in on step 3 for a second. Slippage is absolutely our first critical metric. By definition, slippage is just the rate at which previously good loans are turning bad. Think of it as the fresh flow of bad loans entering the bank's system. It's kind of like, gross NPA is like measuring the amount of dirty water sitting in a bathtub. But slippage? Slippage is measuring how fast that dirty water is actually pouring out of the faucet. If you want to know if the tub is going to overflow, just looking at the current water level isn't going to cut it. You need to know how fast the new water is rushing in. And that's exactly what slippage tells us. So how wide can that faucet actually be open before we need to start worrying? Well, the magic number to remember is 1%. A slippage ratio under 1% is basically the gold standard benchmark for a healthy bank. It gives us this really solid mathematical anchor for our investigation. When you pull up a bank's financials, you want to zero in and calculate that slippage ratio. If it's sitting comfortably under that 1% mark, the fresh flow of bad loans is manageable. The lending engine is working exactly as it should. But if that number starts creeping up past 1%, you know right away that the faucet is opening wider and real trouble is brewing. Now, if slippage is the water pouring from the faucet, what if we could somehow see the water building up in the pipes before it even spills out? That brings us to our second tool, the special mention account, or SMA. The SMA is basically the ultimate early warning system. It's a watch list of loans that are just starting to fall behind on their payments. They haven't defaulted yet, they aren't officially bad loans. But the stress, it shows up right here first. A really sharp analyst watches the SMA book like a hawk because it is literally the earliest possible indicator of future pain. Our source material actually gives us this fantastic, super vivid analogy for this. It says, a growing special mention account pool is the storm cloud before the rain. I love that. Think about it. When you look up at the sky and see dark, heavy clouds gathering, you don't wait for the first drop of rain to hit your forehead before you grab an umbrella, right? You already know what's coming. A swelling SMA book is exactly the same thing. The bank might still look totally sunny and profitable today, but that growing pool of struggling borrowers, that's the storm cloud. And the rain, the actual defaults, is absolutely inevitable. And this leads us right into a really fascinating trap. Let's say the headline gross NPA looks totally stable. The bank is proudly announcing that their bad loans aren't growing at all. Why on earth should we worry? Why even bother digging into slippage and SMA if the main number looks perfectly fine? Well, this right here is the ultimate dirty little industry secret. It fools amateur analysts every single earnings season, and it's exactly why our checklist insists that the order of your analysis matters so much. Because here's the thing, a bank can entirely manipulate that stable gross NPA headline, all while the foundation is literally rotting right underneath them. So, here is the massive red flag you always need to watch out for. If you see rising slippage in a growing special mention book, but the reported gross NPA looks completely stable, that means stress is building just beneath the surface. This divergence is huge. Think about it. If the fresh flow of bad loans is going up, but the total pool of bad loans is magically staying flat, the math just doesn't make sense. How can the bathtub not be filling up if the faucet is on full blast? The answer? It's the illusion of write-offs. Banks can create this incredibly dangerous illusion by taking the oldest, deadest loans out of the bathtub and quietly just throwing them away. They write them off their books entirely. See, by writing off those old loans at the exact same speed that new bad loans are slipping into the system, their total gross NPA stays perfectly flat. The headline looks pristine. Behind the scenes, the bank is furiously bailing water just to stay afloat, quietly tossing dead loans overboard so their headline looks great, while the amateur analysts stand around and applaud. But the detective, the analyst who is actually looking at slippage, they see the truth. So how do you actually protect yourself from falling for this? You arm yourself with a forward-looking toolkit. To successfully nail step 4 of the checklist, you basically need to pull 3 specific metrics from the bank's filings. First up, you need the slippage ratio. Remember, you're checking to see if it's sitting safely under that 1% benchmark. Second, you want the SMA book. And specifically, you want to see it broken down into its overdue buckets. That tells you exactly how late those payments are actually getting. And finally, credit cost. Our source defines credit cost as the annual provisioning expense as a share of the loan book. Basically, this reveals how much hard cash the bank is being forced to set aside right now to cover the bad loans they know are inevitably coming down the pipe. When you put all of these pieces together, when you finally stop staring in the rearview mirror of gross NPA and start actually tracking the trajectory through slippage, the SMA, and credit cost, you get the true output of this whole process. You get a genuine, unmanipulated read on whether the bank's asset quality is actually improving or if it's quietly worsening right beneath a super flattering headline. Seriously, mastering this specific step, it's a total game changer. You stop being just a reactive observer and you become a forward-looking analyst, someone who can spot the storm long before it ever makes landfall. So I'm going to leave you with this final thought as you take this new toolkit out into the real world. Is the bank you're evaluating right now hiding a storm cloud right behind a sunny headline? Next time a bank announces completely stable asset quality, don't just take their word for it. Dig deeper. Pull up that slippage ratio. Check those SMA buckets. See if they're actually just masking fresh stress with aggressive write-offs. Because the numbers always tell the true story of the future, but only if you know exactly where to look.